Excuse me, do you know why property prices go up? Why, yes, property prices go up because of supply and demand. Wait, right there. There is a lot more to it than that, and this week you're going to find out exactly what that lot more is.
Welcome to the Property Podcast, where every Thursday property investors come to be informed and inspired. This is Rob D with a couple of Rob Bs, by the sound of it. But between however many of us there are, we're going to be talking today about a very important subject, and a subject that property investors are quite rightly obsessed with. That is property prices. But we're going to be doing it via a framework that you've probably never encountered before and may just change the way that you think about property prices for good. And stick around to the end because we've got an absolute corker of a book recommendation for you as well.
So it's time for our news story of the week now, and the headline of this story reads, "Demand for rental accommodation in London collapses." Now, this headline is a little bit misleading, not because rental demand in London isn't collapsing, but the article is actually referencing a particular type of rental, Rob.
It is. It's talking about shared accommodation. This is research from Spare Room, which is probably the most popular site for finding rooms in HMOs or other kinds of shared accommodation. And they've seen some big drops year on year. West Central London demand down 43% on last year. The least affected area is East London, and even that is down 19%. So I think you'd put this in the category of not surprising, because we know that London is struggling, and you'd expect shared accommodation to suffer more than any other. With COVID, you're not necessarily going to want to be living with other people if you can help it. And also, a lot of the people who have left London are going to be workers originally from overseas who would have been living in shared accommodation or would have been likely to be living in shared accommodation while they were in London and then maybe went home again when COVID hit. So the fact that this has happened, Rob, is not a shock, but the numbers are big enough to be shocking.
Yes, and as there is so much happening with the London market right now, we need to cover this in a podcast. So in a couple of weeks' time, we are going to podcast about London. We need to talk about London. Is it doomed forevermore? Or is there an opportunity on the horizon? Or something in between? In a couple of weeks, you'll find out.
Another news story that caught our eye this week is from further north, up in Scotland. There's been a bit of a battle going on in Scotland and in Edinburgh in particular around short lets, Airbnb style lets as they're called in this article in Letting Agent Today, where the Scottish Government had drawn up a plan to licence short-term accommodation more stringently and to require planning permission to change a property from a normal home into short-term accommodation in certain areas. These plans at the moment, this news story says, have fallen through in what they're calling a victory for Airbnb, who of course would prefer for this not to happen. Which is surprising because the government did seem dead set on doing this. And indeed the article does say that they're planning to bring these measures back in a slightly different form in the next session of Parliament. So I'd say this is something that's bound to happen in some form, just not yet. But this is a temporary reprieve for anyone with short-term accommodation in Scotland who have probably had a pretty tough year of it given the lack of tourism. And now maybe tourism will be coming back a bit soon and this legislation is not coming in yet. They're probably going to be happier than they have been for a while.
Now you may be thinking, Rob, these are great news stories. But what about the budget? The budget was yesterday. Have you forgotten? Of course not. Of course not. But we record this a few days in advance. So next week, we've got our market update, which of course will be dominated by the budget. So don't worry, we'll be bringing you all our analysis and all our opinions on the budget next week.
Every Tuesday on the Property Podcast, we have an episode of Ask Rob and Rob, and we're always overwhelmed with brilliant questions from listeners like you. But a few weeks back, we received a question so interesting that we not only answered it on Rob and Rob, but we've got more to say on it as well. Here is that question.
Hi Rob and Rob, love the podcast. My name's Jonathan and I'm calling from Manchester. And I was just wondering if you guys have read the UK Collaborative Centre for Housing Evidence and their article, Tackling the UK Housing Crisis, Is Supply the Answer? It's written summer last year and it's just a really interesting sort of journal about whether the supply, that's kind of 300,000 a year housing supply target, is actually the real cause of rising house prices or if it's actually mostly down to interest rates. I'd just be really interested if you guys had a read through it and just commented your thoughts. Really fascinating and just definitely giving me some food for thought.
Well, thank you again, Jonathan, for that question, because it's enabling us today to dig into this so much more. People in property often treat it too simplistically. There is much more to supply and demand than people think about. If supply and demand can be very simplistic if you want it to be, and the explanation of supply and demand can be very simplistic. But just to say that property prices go up because of supply and demand is factually incorrect. It may, as we learn, have an impact, but it is far from the only thing. And while other people will say that supply and demand has no impact, that is also not the case. So let's dig into it. And first, let's understand why each property is in fact in two separate markets. You may have only ever thought property is in one market, the property market, but actually there's two.
Yes, now it's worth saying that this concept of a property being in two markets is not our concept. This is taken from the paper that Jonathan referenced, which we'll link to in the show notes for this episode. It was written by Ian Mulhern, and Ian's written about this idea before. This is where I was exposed to it for the first time. But basically, it draws a distinction between housing services and housing assets. So when you have a house, it actually performs two functions for you. It provides a service, so it gives you a place to live, whether you rent the property or you own it, it's giving you a service. And it also serves as an asset. Again, whether you rent it or own it, it is an asset, it's an investment for you. So for any given house, those markets are not the same, and those markets are determined in different ways. So the supply and demand for a house as an asset is regulated by its price, while the supply and demand for that house as a service, as a place to live, is regulated by rents. This is the real key idea to get your head around to get the most out of this episode, because normally these get kind of mashed together and people just talk about house prices, but actually you can get better insights by separating them out. The reason for that is it's possible that two separate things are going on at once. So you can have a situation where the supply of housing in a particular area as a place to live is higher than demand, so rents fall. Whereas at the same time, the supply of housing as an asset, as an investment, is lower than demand, so prices rise. And a really good example of this is actually what's happening in London right now. So as we've talked about on the podcast recently, in London at the moment, the population is falling. Something like 700,000 people have moved out. And as a result, rents are falling. Rents have fallen by something like 8.5%, which is a really big move in a short period of time. And that is because of the supply and demand for houses as a place to live. There are the same number of houses and fewer people wanting to live in them. Therefore, supply is the same and demand has fallen, so rents fall. At the same time, house prices in London are at least stable, and according to some data sets, are actually still rising a little bit. Not as fast as other areas, but they're still rising, which is not what you'd expect, given that rents are falling and people are moving out. Why might that be? Well, it could be because demand for London property as an asset hasn't changed. We've talked before about the reasons why people from all over the world might want to invest in London property as an asset, and that is unaffected, at least in the shorter term, by there being less demand for housing as a service. So it takes a bit of getting to grips with this idea because it's probably not one you've encountered before. But once you grasp it, you can then start looking at each of those separate markets in turn and getting some really interesting insights from it.
So rents are based on simple supply and demand. Of course, earnings are a factor too, however constrained supply is. There's a ceiling percentage of their earnings that somebody can afford to pay. If there aren't enough houses to live in, this should result in rents rising. But they've grown slower than incomes over the last 15 years. So this implies that the supply of houses as a place to live has been adequate to reduce its cost relative to incomes.
Now, at this point, it's worth saying that this doesn't just apply to the rental market. It applies to homes that are owned by owner-occupiers as well, because economists, as well as looking at rent, look at something called imputed rent, which means the rent that you would be paying to live in that house if you didn't actually own it. It's rent that you're paying to yourself, effectively. So they look at that as well. So when they're looking at these figures, it's not just houses that are in the rental market. So this is a bit of a mystery. We see all the time how not enough houses are being built to keep up with demand. There's a housing crisis, which is normally taken to mean we're not building enough houses, therefore they're too expensive. But when you go and look at this demand for houses as a place to live, prices have actually fallen slightly relative to incomes. So if in fact enough houses are being built to accommodate the demand for places to live, which is what's implied by the fact that rents and imputed rents are falling, why are house prices going up? We're not saying that house prices are secretly falling. They're definitely not. Why is that happening? Well, that's because of the other market. We've looked at the market for houses as a service, but there's also the market for houses as an asset. And in that market, supply and demand is a factor, but that's not the only one.
So now let's talk about the assets market. And this is the market that most people will talk about when they talk about property. So the price of property as an asset is determined by supply and demand, the cost of capital or the cost to lend, taxes, or future price expectations, or sometimes referred to as sentiment, how people are feeling about the property market. And sentiment in particular is why property prices over and undershoot in bubbles and busts, because there's so much emotion involved. So yes, emotion does drive property markets as well. So there's a lot more to it than just supply and demand. So why is there a demand for houses as an asset? Well, with bond yields close to zero at the moment, then even a low yield from property is relatively more attractive, pushing up demand. And remember, bonds are close to zero because of QE. So QE has a huge impact on property prices as well. And something we've talked about quite recently on the podcast. If you haven't listened to that episode on quantitative easing, you really must listen to it, because if you don't understand that, you're missing a piece of the jigsaw. Property is also seen as a safe haven in certain areas, and that will drive international demand. So prices have grown rapidly in many global cities, like London, Vancouver, Chicago, Sydney, Hong Kong, Amsterdam, etc. These areas are where property is most likely to be valued as an asset, while prices have grown more slowly in outlying UK regions compared to the southeast, because investment demand, including international demand, is lower. So you could use a Mayfair apartment as an alternative to a gilt, but you're not going to get much international demand driving up prices of semi-detached houses in Sunderland, for example.
So all the factors that Rob mentioned are reasons that the demand for property as an asset could be increasing, pushing up its price, even though demand for property as a place to live may not be increasing. But as Rob also said, there are other factors that determine the price of property as an asset as well. There's supply and demand, there's sentiment, there's taxes, and there's also the cost of capital. In other words, how much does it cost to borrow money to buy property with? And this is a really important factor that's worth going into in a bit more depth. So you can think this through from a couple of different perspectives. If you take the owner-occupier perspective first, say interest rates are 5% or mortgage rates are 5%, that's what it costs you to borrow to buy a house to live in. Well, at that rate, you might be able to afford, based on your income, to borrow £150,000 and still not be paying any more to live in the property as you would to rent it. So with rates at 5%, you can borrow £150,000 and your cost will be round about the same as it would be to rent the property. So you decide to buy it instead. But then imagine that interest rates fall to 2%. If you could borrow at 2%, then you're going to be paying less, obviously, for your mortgage. And that means you could afford to borrow more while keeping the cost comparable with renting. So you might therefore be able to borrow $300,000. That means that by the cost of borrowing falling, everyone can afford to pay more for the same thing, effectively, which of course sellers are aware of, and that pushes up prices in the market. That's the owner-occupier perspective, but the same is true for investors as well. So if rents stay constant and borrowing costs fall, then you can effectively afford to pay more for a property and still get the same ROI as you would have done before. So whatever the purpose of buying property as an asset, the cost of capital has a really big factor on how much you can afford to pay and therefore how much sellers charge. And indeed, the Bank of England put out a really interesting paper, which we'll link to in the show notes again, showing that the entirety of house price rises relative to income since 1985 can be accounted for by the base rate falling over that period of time. Now, of course, you don't actually know what's caused property prices to rise. It's an impossible question to answer, but they've done a statistical analysis and said that could account for all the price rises. So clearly the cost of capital is a big factor. And it's worth saying as well that the cost is only one factor. Mortgages need to be available as well. It's no good having cheap credit if you don't have an adequate supply of it. So we saw this in a couple of years following the last financial crisis. The base rate absolutely plummeted, but no one wanted to lend. Therefore, that wasn't a factor that supported house prices. And indeed, they didn't go up. So the picture we built so far is of a fairly simple supply and demand based model when it comes to houses as a place to live, but a far more complicated model when it comes to housing as an asset, of which supply and demand is just one factor. This is probably going to be a new idea for a lot of people listening. It might be something that you buy into straight away, it might not be. But if you do go with this argument, what does it mean?
Well, it means that increasing supply would reduce rents far more readily than it would reduce prices. It means building more homes in areas where prices have risen fast, like London, would reduce prices, but it would need to soak up the international demand for assets, but not local demand for places to live. And the most likely cause for prices falling will be a rise in the cost of capital. which the Bank of England and the Fed have ruled out for years. So as we've seen, the services market reacts a lot more quickly and is a lot more sensitive to supply and demand, whereas the assets market, property prices, are affected by supply and demand, but more over the long term. It doesn't move prices that dramatically. The dramatic rises and crashes that you see in property are mostly down to the cost of credit or the availability of it, and sentiment, how people are feeling about that asset. Are they bullish or are they scared? It's normally extreme emotions that cause extreme movements in the property market. Supply and demand doesn't impact property prices in the short term. So when people say, oh, why do property prices go up? And people say supply and demand, while it's technically true, as we've learned today, there's a lot more to it. And that's what we've wanted to do today, is explain that there is a lot more to it. And as a property investor, if you truly understand all the mechanisms behind supply and demand and the other factors that are having an impact as well on property prices, then as an educated investor, you're going to be far better positioned for movements in the markets because you understand why things are happening. Now, don't worry if this is a lot to take in. You can go back and listen again, and I recommend you do if this is a new concept to you. My own understanding of supply and demand over the years has developed. And it's okay to, at the beginning of this podcast, to have one point of view, and by the end of it, have an updated point of view. It wasn't that you were wrong before, you just understand more now. And that's what we want to do on the Property Podcast, is help you understand these big picture concepts like QE, as we covered recently, and now supply and demand, that you understand them on a much greater depth than just surface level, because you, as a property investor, will be far better off. So it's time for Hub Extra, the part of the show where we want to give you a bit more. And of course, remember, sign up to the Property Hub website to get the Hub Extra email every Friday, where we give you a ton of resources to enhance your week. And Rob, I believe you're about to enhance my week as well, because you've got a book recommendation.
I have, and I need to give credit for this recommendation to my wife, who listened to this book first, and indeed most of my recommendations come from her, but for the purposes of this podcast, I can take the credit. The book is called Alchemy, The Surprising Power of Ideas That Don't Make Sense, and it's written by Rory Sutherland, who is the vice chairman of WPP, which is a massive advertising agency. And if I can try to sum up his core argument, it's basically that everyone is always in business making decisions based on logic. But in fact, most people's buying decisions are not governed by logic. So actually, by approaching things in a completely logical, spreadsheet-driven kind of way, you miss really great solutions to problems that often are far simpler and cheaper than the solution that logic alone would get you to. I think it's just a fascinating book because it's a combination of business and marketing and psychology, which are two of my favourite subjects. So it's the dream book for me. So if you like anything along those lines, I strongly recommend it. And I also strongly recommend getting the audio version because the author reads it and he's just got a brilliant voice as well. It's so much fun to listen to, really funny. So yeah, get Alchemy by Rory Sutherland added to your reading list.
I will, Rob, because you recommended a bit of a stretch last year as one of your top books to listen to, and I am close to finishing that book now on Audible, and it is absolutely fantastic. So if you didn't pick that up on Rob's last recommendation, do, because you're getting double down recommendation on that one now. It's a fantastic book. And because you've done so well at recommended books before, Rob, I'm going to add Alchemy to my list now.
Well, you will not regret it. And you, dear listener, will not regret tuning into the Property Podcast again next week, because we're going to be back with another big episode next Thursday. We've also got Ask Rob and Rob on Tuesday. And as mentioned earlier, Any Other Business is now dropping into your podcast feeds on Monday. And you can get it a little bit early if you just can't wait on YouTube on Sundays as well. So that's a few dates that we've got with you for next week. We'll see you then. Bye-bye.
Bye-bye.